Hello, everyone, and welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about commercial real estate. I wanted to get everyone an update on kind of what's going on in the market, and hopefully, people will find this informative. So please hang out as we kind of go through. I'm gonna break down the different real estate segments. And then, like I said, get you to kind of a point where hopefully you're caught up with everything. So hopefully hang out to the end of the video to see what you think about this. So first thing, I just want to do a very quick explanation. So when I talk about commercial real estate, what am I talking about? Well, commercial real estate has four main segments to it. You have the commercial office market, you have the commercial retail market, you have the commercial industrial market, i.e., industrial real estate, and then you have the multifamily market, apartment buildings. Those are the four main components of commercial real estate. There is one other one that I would describe as mixed use properties. Now, what is a mixed use property? Well, a mixed use property usually has some component between two of those major four categories, usually apartment and usually either office or retail space are usually combined. Like, in other words, in a lot of the downtown areas of major cities in the United States, you might find a lot of buildings that have retail on the first floor and apartments above them. Or you're starting to see certain types of buildings constructed today that might be a mixture of, like retail on the first floor, maybe maybe a hotel that might be on the fourth, fifth, sixth floors, and then on the seventh floor through the 15th floor, you've got apartment units. Mixed use properties could also be what I would call smaller Main Street properties. Like, in other words, if you have a main street in your neighborhood, maybe you've got houses that have been converted into small office properties over time. Like, in other words, maybe you had a property that an insurance broker or a doctor purchased, and maybe they turned the first floor of that building into their office, and maybe they converted the top floor or top couple floors into apartments. So maybe you got one or two apartments above it. So that would be an example of, again, another example of what I mean when I'm talking about a mixed use property. So let's get into what's going on in these different sectors. So right now in the retail sector, I think you've got a situation where retail properties can be very hit or miss. If you've got a very nice retail property in a great location, if it has what's called an anchor tenant, in other words, usually the anchor tenant would either be a food store, or it could potentially be some kind of like a fast food restaurant, like a McDonald's or a Chick-fil-A, something of that nature. But generally, your major food stores, your Albertsons. And again, in the kind of the Philadelphia area, we have like the Acme, we have Giant. I'm laughing about that because we in the Philly words, we have the Acme. It's a funny thing, but I digress. But in other parts of the country, I mean, you might have Food Lion, you might have Publix, you might have some of these other major food stores that are out there. And those are basically the food stores that would be your anchor tenant for a shopping center per se. So if you have that, then you're probably in a shopping center that's probably pretty stable, probably sees good traffic count coming in and out, probably has a good base of tenants that have been there for a long period of time. If you have a smaller retail property, say it's kind of a little bit off the beaten path, or maybe it's not in a major market, maybe it's kind of just outside a major market, say it's anywhere from like a 6 to 10 unit kind of classic retail strip center, it'd just be like a straight line of units facing the street, and you've got those units in there. Well, if you've got a lot of like, say, mom and pop operators in that retail space, that might be a little spotty, might be a little hit or miss. I think it really depends on the strength of the mom and pops, how long they've been there, what type of businesses they have, what kind of mixture of companies you have occupying that space, and also the demographics of the area. Are the demographics changing? Are they growing, contracting? What's kind of happening there? So I think the retail sector is a little hit or miss right now. In the industrial space center. So industrial space right now, I think, based on numbers and things that I've seen, they seems to be pretty solid. There's a lot of questions right now. Are we seeing an overbuilding right now of industrial space that's not going to get absorbed into the market? Well, Maybe. So far, we haven't really seen that. However, what I would tell people is to keep an eye on the really large industrial properties, and I'm talking about the anywhere from 500,000 to a million plus square feet type properties. Because I mean, we've really seen a pullback from Amazon in the last year or so, as they've basically said, you know what, during the pandemic things really took off, but now that's kind of really slowing down. So you've seen Amazon, being committed to a number of different properties around the country where they've kind of pulled back on that. However, I would say, your smaller industrial properties are probably going to be just fine. If you've got a space that's under 100,000 square feet, probably not going to have much of a problem finding a tenant for that property right now. I mean, it just seems to be a huge demand for those type of smaller industrial properties out there in the market still, even despite higher interest rates and things of that nature. But I would say, I would add a caveat that there has been a little bit of a slowdown in that segment of the market, but like I said, nothing that would cause major harm or be a big worry at the moment. What are the other segments? The apartment segment. So we've seen kind of this giant buildup in the apartment industry over the last couple of years. During the pandemic, major flight. All of a sudden everybody shifted gears and said, "Hey, we really don't want to be building office space. We don't want to build retail space, but we want apartments, and we want to go heavy into apartments." So you've seen a ton of apartment building across the country right now. Still have a ton of apartments that are scheduled to come into the market. So there's a lot of apartment units that have yet to come in, that will come in the next year or two, that have to be absorbed within the marketplace. But I think one of the big keys there is rent. We saw a huge run up in rental income from a lot of apartment property operators over the last couple of years. Rents really went through the roof. It looks like, for all intents and purposes, that has kind of peaked for the time being. That you saw this huge increase in rents over the last 3 years. Now we've kind of gotten to a point where I don't think it's so. In other words, I'll phrase it this way: if you're an investor and you're out there in the market and you're looking to buy an apartment property, I don't think you can really make the case that, oh, okay, well, I'm going to buy this property, and if rents are already at kind of market peak or the top of the market, you're not going to be able to go in there and say, oh, I can add value by increasing the rents on all the tenants. Like that's probably not going to happen. So I think as a real estate investor out there, you've really got to be taking a hard look. I mean, if you're out there looking to buy apartment properties, you got to take a really hard look at that rent roll and look at the expenses that are associated with that property. I mean, as we've all seen, expenses are really going up kind of across the board. I mean, you're seeing insurance expense go up, utility expense go up, property tax expenses going up. Interest rates are going up, so that's causing much higher mortgage payments. So I think you have to take a lot of that into account. You've really got to crunch the numbers on the rent roll, really got to look at the expenses associated with that. Overall, though, I would say I think that the apartment market is probably going to remain stable for the foreseeable future, unless we have kind of a collapse of the labor market. I'll put it this way: I don't think the labor market is going to be as strong going forward as it has been the last few years. I do think we're going to start to see a slowdown in the labor market. I think we might even see some months where that the growth of jobs actually goes negative in the next 6 to 12 months. But we'll see how that's playing out. But for the most part, I think apartment properties are very stable right now. You're still getting very good rents, and things are going really good. If you've owned properties for a long time, or if you bought properties before, I would say 2022, you're probably sitting in a pretty good situation right now. Your rents, your rent roll's strong, your rents are pretty stable, things are good. So that's kind of my take on the apartment market. Now, here's the big one: the commercial office space. A lot of interesting things going on with commercial office space. Obviously, you have the whole remote work situation where a lot of the major corporations in America sent people home, had them working remotely during the pandemic. Now that the pandemic's over, trying to get people back to work, a lot of companies have basically said, nah, I really don't want to go back to work. I'm kind of happy working from home. They're finding that has worked for the most part for them. I have some questions on that because I find the whole remote work phenomenon to be a very interesting thing that's happened recently, and I'm probably going to do a podcast episode just on remote work because I have a lot of thoughts and ideas about how that ultimately affects the culture of your company, and how that works. Onboarding, offboarding, the corporate culture. So that's something I really want to dive into, and I don't want to get too off point on that. But what you're having here is you've got commercial office space, and a lot of companies are basically saying, hey, we're paying a lot of money for this commercial office space for space that we really don't need anymore. So can we downgrade this space? Not that they're not going to have any office space anymore. They're just looking to downgrade. So in other words, for example, say you're a business, you've got I don't know, we'll say you've got 300 employees, and you have rented 150,000 square feet of office space. Well, you might wake up one morning and just sit there and go, hey, you know what? We don't need 150,000 square feet. We just need 75,000 square feet. So as soon as your lease is up, maybe you've got 2 years left on the lease, and then, you're going to sit there and you're already reaching out to the landlord saying, hey, man, in 2 years, we're not going to need all this space. So we're going to look to downsize. If we could downsize us in the building where we're at, that's great. If not, then we're going to go, move to a space down the street, which we think might be better. So as a result of that, a lot of landlords out there right now, their rent rolls, as you were, are really starting to see some problems because they're having a lot of tenants move out. They're having a lot of tenants downsize. And what happens with commercial real estate is commercial real estate, the value of it is really driven by the strength of the rent roll for that particular property. So when you start losing tenants, if you lose more than 5 or 10% of your tenant base, the value of that property can really go down. And so as a result, landlords, they get to a point where they go, you know what, if this property, if I've lost 40 or 50% of my renters, and this property is no longer cash flowing, and they can't make their payments on the mortgage payment to the bank, a lot of times they're just kind of wiping their hands with it and going, hey man, I'm done. Hand the keys back to the bank and let the bank deal with it. So that's generally what happens. And then the property gets put into receivership. And then you might have a what's called a special servicer come out and service the property on behalf of the bank. And then kind of go from there and then see if they can what's called dispose of the asset. In other words, just sell the asset, whether they do that as a private sale or through an auction or whatever. But let me just run through a couple articles here real quick. So I had an article here on just, where distressed commercial real estate loans are piling up. And it basically goes into showing I think the top 3 markets right now are Chicago, Denver, Philadelphia, and San Francisco, and Houston to round out the top 5. Chicago is really seeing a huge amount of distressed commercial office space. Denver not too far behind it, and then you kind of have Philadelphia, San Francisco, and Houston are all about right in the mix there. Then you kind of got Washington, D.C. and New York following steady behind there. We just saw an instance. So some office markets may be close to bottoming out while others are showing more cracks. And again, kind of covering the same areas that the other article covered, basically saying, yeah, San Francisco's got continued issues. Chicago's got continued issues, but some of the issues might, potentially be stabilizing, like, Miami, Phoenix, Austin, Texas, places like that. Then we got, investor activity slides amid a more challenging housing market. So this basically talks about how investor activity, like in other words, if you're a real estate investor looking to buy investment properties, if you're looking to flip houses, then that activity has dramatically slowed. Slowed to a crawl, slowed to a point where, we haven't seen in probably, 12 or 13 years. So, and then here's another interesting one. So construction firms cite labor as the biggest challenge despite the slowdown in housing starts. So in other words, for home builders, residential home builders, they're basically saying that one of the biggest problems that they have right now is they just can't find the labor. They can't find the labor to build a lot of these houses. They can't find the labor that has the skill to perform a lot of the tasks they need when building a house. Certain aspects of residential home building is very specialized. So, and you need people that know what they're doing to help you build these projects. So that's basically my update. That's my update right now on commercial real estate. So just to kind of recap that real quick. So residential, retail, commercial real estate's probably a little spotty. Industrial's holding up fine for the moment. Apartment properties are holding up fine for the moment. The real problem zone right now is in commercial office space, and that's the area that we all need to keep an eye on and kind of see what happens and how that continues to unfold and play out over the next year. I will tell you that one of the big things is that a lot of the commercial real estate debt is going to reprice in the next year or two. What does that mean? So commercial mortgages work very differently from a residential mortgage. Residential mortgage, you might get a mortgage for 30 years. It's a 30-year fixed rate and off you go. Commercial mortgages do not work like that. Commercial mortgages typically could have a 5, 7, 10-year repayment period, and the loan would be based on maybe a 25 or a 30-year amortization. So after 5, 7, 10-year period of time, that loan is going to mature, and then the interest rate needs to be reset. The loan needs to be renewed for another period, another 5, 10-year period, and continues on the same amortization, but that debt gets repriced. And I could have a whole conversation on why that is or why that happens. But basically the point is that debt's going to come up for repricing very soon. And that repricing at the higher interest rates is going to have an impact on the landlord, the owner operator's cash flow. And the cash flow is definitely going to be impacted by this. And the question is, what is the extent of that impact? Are they able to afford this or not afford it or whatever? But we'll have to keep an eye on that and continue to see what happens. So if you like what I said today in this commercial real estate update, I would just ask everybody, please like, subscribe, and share the podcast. That always helps us out. I will have some other episodes coming up real soon. I've got a couple book reviews that I've been working on that I really want to roll out that I'm hoping people will enjoy. Also have kind of an economic update video that's going to be coming out here real soon. I'm just going to run through a whole bunch of economic indicators and just kind of let people know here's where we're at right now and here's where we're going in the future. So keep an eye out for that. But please leave a comment in the comments below if you have any thoughts on what you think is happening with commercial real estate or what you think how this thing might play out over the next 6 to 12 months. But like I said, other than that, I hope everyone has a great day and hope to see you again real soon. Thank you so much.